I'm making this short podcast for primarily BLC students who didn't get the opportunity with me to go through the rules of tracing and to have a look at how you should answer a problem question that involves issues of tracing. This is important because the BLC assignment problem question for equity and trusts law will include issues of tracing. The podcast should also be useful for anybody who just wants a little bit of extra guidance. What I'm going to do is I'm going to give a brief overview on the theory around tracing, which will take about 5 minutes, and then I'm going to go through one of the problem questions and how you should answer it, which you can find in the workbook. So tracing generally, so the idea of tracing is that it allows a claimant to assert that a form of proprietary interest has been substituted for another one. Like, that's its primary function. The definition of tracing that I've given you in the workbook comes from Lord Millett in the judgment of Foskett and McKeown, where he said that tracing is merely a process by which a claimant demonstrates what has happened to his property, identifies its proceeds and the persons who have handled them, and justifies his claim that the proceeds can properly be regarded as representing his property. Tracing allows that where there's been a breach of a fiduciary duty due to a misappropriation of trust property, and the trust wants to identify where that property is or where its equivalent is, so that they can establish either a personal or a proprietary claim over the property. With regards to that last point, tracing is used as the mechanism to identify the property so that we can then use the appropriate remedy, which will be either a personal remedy or it will be a proprietary remedy in the form of either an equitable lien over a portion of property that has been purchased partly using trust funds, or a constructive trust where the entire property has been purchased using misappropriated trust funds. Generally speaking, the law of tracing assumes a series of evidential presumptions. So, for example, when the claimant's money has been mixed with the wrongdoer's money, the fiduciary's money, and then some of that has dissipated, then the claimant has the ability to elect, to choose to rely on the presumption that the wrongdoer spent his money first, or that they spent the claimant's money first, whichever is the most beneficial. Alternatively, if two innocents' money has been mixed, the starting presumption is the first in, first out rule, which is the rule from Clayton's case. Although it should also be emphasized that this can be displaced on equitable grounds in favor of a proportionate share of the remainder, the pari passu rule. Also, before the judgment of the Privy Council in Brazil and Durant, it wasn't possible for the presumptions to displace any evidence to the contrary, which led to two of the bars to tracing, two of the limitations on tracing. The first being the lowest intermediate balance rule, which is that the claimant can only ever trace into the lowest point in the fiduciary's bank account where trust funds are mixed with the wrongdoers, and backwards tracing, since tracing from asset to asset has to follow a chronological order. In relation to backwards tracing, the original argument in favor of backwards tracing was given in the judgment in Smith by Smith, who argued that although it's possible to trace a debt itself, it should be possible to trace backwards into the asset that was acquired in exchange for incurring the debt. There have been multiple judicial statements arguing against the ability to backwards trace. For example, Lord Justice Leggett in Bishopsgate, Hobhouse and Foskett and McKeown, who said that to allow tracing into an asset that the defendant acquired before receiving the claimant's money wasn't possible, shouldn't be possible, because the equity in the trust property cannot properly follow into something that was acquired before the misappropriation. The argument in favour of backwards tracing, and we now know that it is possible, the original arguments were given by Lord Justice Dillian in Bishopsgate, Scott in Foskett and McKeown, who all said that the rule should be based on substance and not timing. Ultimately, the asset was bought with the claimant's money, and the court shouldn't be restrictive in its decision by the precise order in which the payments were made. That was followed by the Privy Council in Brazil and Durant, where the Privy Council accepted backwards tracing, but only where there is a clear coordinated scheme involved in questioning the transactions. So to get that judgment, the authority there I've included in the workbook. The Privy Council at paragraph 34 used the language that there has to be a close causal transactional link between the incurring of a debt and the use of trust funds to discharge it in order to permit backwards tracing. In that judgment, Lord Tolson, for example, rejected a broad acceptance of backwards tracing in English law that would have allowed the claimant to trace his equitable title into whatever was acquired with the loan funds. And the court specifically mentioned, in agreement with Scott's observations in Foskett, that the use of backwards tracing has to depend on the substance of the transaction. Therefore, an exception was formed to both backwards tracing and the lowest intermediate balance rule, where the steps in question are part of a coordinated scheme or a deliberate part of the choreography. The reasoning expressed is to combat the more increasingly sophisticated and elaborate methods used to launder money. But it should be worth mentioning that the court decided not to widen the scope of backwards tracing to allow tracing into whatever the defendant acquired in exchange for the debt. And so that's a very brief introduction to tracing generally. So now I'm going to look at one of the problem questions in the workbook, and I've chosen to look at the problem question number 4, which you'll find on page 38 of the workbook. So if you could pause this podcast and go to page 34, and I'm going to look at that question now. So that's the question about Zeus, who is the sole trustee of a trust fund set up to benefit Jason and Theseus. So this is a typical question. You've been given 4 scenarios and you've been asked to advise on each of them. You've not been asked to discuss the issue of whether there's been a breach of the fiduciary duty of the trustee. It's clearly stated at the beginning of the question that Zeus, as the sole trustee, has misappropriated £50,000 from the trust fund. So all you've been asked to do is to identify which tracing rule is going to apply and which remedy, be it proprietary or personal, is going to be used by Jason and Theseus, by the trust, in order to recover those misappropriated funds. So, as a brief introduction, what you should do is just define what the fiduciary relationship is, the duty of trust and confidence. You can use from the workbook Lord Millet's statement in Bristol and West Building Society in Mothew. You might also want to go a little bit further and identify what the duties of care are at the statutory level under Section 1 of the Trustees Act 2000, how the common law duty of care deals with different situations, and then give a definition of tracing, possibly also from Lord Millet in Foskett and McKeown. Once you've given that brief introduction, say that you're going to take each of these issues separately and advise Jason and Theseus on each of those points. So starting with issue A. So Zeus paid £10,000 into his bank account at the Olympic Bank, where he already had £18,000 of his own money. He then withdrew £8,000 to purchase a sculpture by Hephaestus, who's an up-and-coming artist, and he then withdrew the remaining £20,000 to buy shares in a new matchmaking company set up by Eros. So he's mixed trust money which he has misappropriated with his own money. Yeah. So starting with the sculpture. So the authority that you can rely on for the issue of the sculpture is re Hallett's estate. So if we assume using that authority that the trustee had acted rightfully by preserving the trust property and not using it for unauthorized purposes, then the trust cannot trace the trust funds into the sculpture. So we're relying on whatever's left in the account, assuming that there is money left in the account, or we may wish to instead trace into the shares with our £10,000 taken from the trust. That might be beneficial if the shares have increased in value. So applying that rule in Hallett's estate, you should then move on to the next legal rule, which is re Otway, which allows us to argue that the assumption that the trustee is always preserving trust property is a rebuttable presumption. And instead, we can claim that the money that's been taken out of the account first is the trust's money. This will then allow us to trace the equitable title in the trust money into the sculpture and therefore claim a proprietary interest in it. The next step is to move on to the shares. So we know that at least half of the money, well, we can say that half of the money that was used to buy the shares, £10,000, used to buy £20,000 in shares, was with the misappropriated trust funds. Applying re-Diplock, we can trace into the shares and claim a proprietary remedy over half of them. The next issue is that Zeus gave £5,000 to his son Perseus. Perseus used the money to pay off a loan he'd taken out 6 months ago to buy weapons. Perseus had originally asked Zeus for the money and had taken out the loan when Zeus had replied that he had no spare funds at the time, but might be able to help him out later in the year. So this is the issue of a loan. The money was paid off, so it's a question of backwards tracing. First point, identify whether Perseus is an innocent volunteer or whether he's knowingly in receipt of this money. Usually when using trust funds to pay off a debt, tracing is impossible as the money has been dissipated. This was established in re Diplock. But if we rely on the Privy Council's decision on Brazil and Durant, there would have to be a causal link and a transactional link between the incurring of the debt and the use of the trust funds. Zeus told Perseus he didn't have the funds at the time, but he would later. That's not enough to say that Perseus had constructive knowledge of the breach of trust. So using the judgment of Boscawen and Badjoa, it wouldn't be possible, in my opinion, using the information that we have to say that Perseus knew where this money was coming from. And therefore, it wouldn't be possible to recover this money from Perseus, and the conclusion should be that the £5,000 has dissipated. The next issue is that Zeus used £20,000 to replace the windows in his house. And since the manufacturer was running a 2-for-1 deal at the time, he also had the windows replaced in the house of his daughter Athena. So dealing with Zeus's windows first, the issue here depends on whether or not the value of the property has increased. If it hasn't increased, then if we apply re-Diplock, we would have to conclude that the money is dissipated and untraceable. If the value of the property has increased, then it is traceable, but only to the maximum value of the expenditure plus interest. And the authority that we have to rely on there is Lord Brown Wilkinson and Foskett and McKeown. Which leads us to the question of Athena, and the same problem here exists. If her value, if the value of her property has increased, then we will be able to trace. But if we are claiming against an innocent party whose property hasn't increased in value, then again applying re-Diplock, the money has to be viewed as dissipated. If the property has increased in value, there are comments by Scott and Foskett and McKeown, Lord Justice Hobhouse in the Court of Appeal, and Lord Brown Wilkinson in the House of Lords, all who say that tracing may be permissible, but only if it isn't unfair. If it wouldn't be fair to claim against Athena for the value of what she's received in the increase in value, or value of what she's received in improvements to her home, then we would also have to conclude that this property is dissipated. The final issue is that Zeus ran an investment fund through a current account at the Delphi Bank. He'd already invested some of the fund in shares in Minotaur PLC, leaving £15,000 in the account when he paid in the last £15,000 from Jason and Theseus' trust fund. He withdraws £20,000 to buy shares in Cyclops PLC and then spends the remaining £5,000 on a holiday. So applying what we've already used in the previous three examples, we can conclude that with regards to the shares, Foskett and McKeown applies. The money used to buy the shares is misappropriated trust property and it's therefore traceable, and we can recover it either in its entirety in the form of a constructive trust, where we're saying that Zeus may be the legal owner, but he's only the legal owner as a constructive trustee, and the equitable title in the shares at all times belonged to the trust set up to benefit Jason and Theseus. And with regards to the £5,000 spent on the holiday, that has dissipated and it is untraceable. So if you just take those rules from what I've said already and what you can read in the workbook and on the lecture number 5 recording on tracing, that should be enough to get you through that element of the problem question in the assignment.